Have you ever seen a company release its quarterly results and just felt lost? Like you need an accounting degree just to figure out what's going on? Well, we're going to fix that today. We're going to dive in and learn how to read a company's report card. And I promise, it's way easier than you think.
Yeah, you open one of these things up and boom, it's a wall of numbers, jargon, and tables. It looks completely intimidating, almost like it's written in a different language. But trust me, our mission here is to crack this code together.
Because here's the little secret. Behind all that complexity, there's actually a super simple story. It's just a story of how much money a company made, how much it had to spend, and what was left at the end of the day. That's it. Just money in versus money out.
And to understand that story, you don't need to be some kind of financial wizard. Nope, all we need is one single key. Just one simple formula that unlocks the whole thing.
That's right. Every single one of these dense, complicated-looking reports, doesn't matter if it's for a tiny startup or a massive corporation like Mahindra and Mahindra, which is what we're looking at today, it all boils down to one fundamental equation.
And here it is. Income minus expenses equals profit. That's it. This is the backbone of the entire financial statement. If you can get your head around this, you understand the core of the business. Everything else is pretty much just detail. So let's use this to break down the report.
All right, first up, let's tackle the income part of our formula. In the business world, you'll often hear this called revenue, or the top line. And you know why? Because it's usually the very first number you see right at the top of the page. So let's go looking for that number. On the statement, you'll see a line that says total income. This is every single rupee the company earned during this period, from selling cars, tractors, you name it. A good way to think about it is like the company's total salary before any of the bills get paid.
And for this quarter, that number is a whopping 42,708.20 crore rupees. That is a huge number, and it's our starting point. That's the total amount of money that came through the door.
So we've got our top line, but of course, as they say, it costs money to make money. So now we have to look at the second part of our equation, the expenses, all the money that's going out.
And you'll usually find it right below the income section, a line item called total expenses. This covers everything: the cost of raw materials, paying employee salaries, marketing, keeping the lights on. You get the idea. This is the company paying all of its bills.
For this quarter, the total cost of just doing business was 37,096.05 crore rupees. Now that's another big number for sure, but what really matters is how it stacks up against the income.
Okay, let's put it all together. On the left, we've got the money that came in. On the right, we've got the money that went out. Now, for the moment of truth, let's do the math.
This brings us to the final, and you could argue the most important part of the whole story, the profit. This is what everybody's waiting to see. There's a reason they call it the bottom line.
So here's the big question. After earning over 42,000 crores and spending over 37,000 crores, did the company actually make any money? What was left in the pot?
The specific term we're looking for is profit after tax. This is the real measure of success. It's the clean, final profit after every single cost, including paying the government its share in taxes, has been taken out. This is the true bottom line.
And the answer is, drumroll please, 5,631.47 crore rupees. That is the net profit. That's the reward the company gets for all of its hard work during the quarter.
Okay, but that's a huge, almost abstract number, right? What does that actually mean for a regular person? Maybe someone who owns just one tiny piece of the company. Let's bring this down to a more human scale.
This is where it gets really interesting, especially if you're an investor. How do you translate a profit of thousands of crores into something that makes sense for a single share?
Well, we do that with something called earnings per share, or EPS for short. It's a really simple but powerful idea. You just take the total profit we just figured out and you divide it by the total number of shares the company has out there. It tells you exactly how much profit belongs to each individual share.
And in this case, the basic earnings per share works out to 41 rupees and 69 paise. Now that is a number we can actually wrap our heads around, right? It's a key number that investors watch very closely.
So a great way to think about it is this. EPS is like the take-home pay for each share you own. It's one of the quickest and easiest ways to check how profitable a company really is, and it shows you the direct link between the company's success and the value for shareholders.
And just like that, you've done it. You took a really complex financial document, you found the top line, the expenses, and the all-important bottom line. You even figured out the earnings per share. You now have the basic tools to understand the fundamental story of pretty much any public company out there.
So the next time you see a company release its earnings, you're not going to see a foreign language. You're going to see a story. And that leaves us with just one final thought. Now that you know how to read the report card, what grade would you give this company? That's for you to decide.
I was staring at the source material for today's deep dive for maybe 20 minutes before I even really knew what I was looking at.
Yeah, I get that.
At first glance, it just looks like a cardiac monitor in some sci-fi movie. You've got this, stark black background, these jagged green and red towers rising and falling.
And those neon lines winding through everything like arteries.
Exactly. It's chaotic.
It definitely has that aesthetic. But, in a very real way, cardiac monitor is the perfect analogy. It is a heartbeat.
Yep.
It's the pulse of thousands of people, buyers, sellers, institutions, even algorithms, all making these split-second decisions based on, well, fear, greed, and hope.
And that's what we're decoding today. We aren't reading a book or summarizing an article. We are reading a single image.
Mm-hmm.
It's a candlestick stock chart for the Nuvama trading interface.
And the subject is a heavy hitter. M&M, Mahindra and Mahindra on the National Stock Exchange.
An industrial giant.
Right. But we're not talking about their new SUV launch or their tractor sales figures today. We are strictly looking at the technicals. We're going to decode the story of what happened to this stock's price between, September 2025 and right now, mid-February 2026.
And what a story it is. I mean, just looking at this chart, you don't need a finance degree to see that something pretty dramatic happened in January. It looked like a cliff edge.
It was a violent move, absolutely. But the goal of this deep dive isn't just to say it went down. We want to understand the texture of that move. We want to peel back the layers.
Okay.
We have the price action, that's sort of the main character.
Yeah.
Then we have the volatility, shown by these things called Bollinger Bands. And finally, the momentum, measured by the RSI.
Right. And for everyone listening, I really want you to visualize this. Imagine that dark screen. You see the price. Candles green means the stock closed higher than it opened. Red means it closed lower.
Simple enough.
And overlaying that are three wavy lines, two green ones on the outside and a red one in the middle.
Those are the bands. And then at the very bottom, you have a separate row of vertical bars. That's the volume. And then sandwiched in the middle is a single line graph. The RS, it's a whole dashboard.
It is. Okay, let's play detective. Let's walk through the timeline because this chart tells a chronological story. If we look at the far left, late 2025, so October and November, it looks like a completely different world compared to now.
Oh, it was a bull market for M&M. You can see it so clearly. The trend is moving from the bottom left to the top right.
Right.
The candles are predominantly green, and they're healthy. They have good size to them. That indicates conviction. Buyers were stepping in every day, pushing the price up, and holding it there.
It looks smooth, almost like a steady hike up a mountain. Mm-hmm. But then we hit December. And this is where the plot thickens. The line stops going up. It doesn't crash, but it just stalls.
That is the December stagnation. And visually, it's quite distinct. Look at the size of the candles in December compared to November.
They're tiny.
They shrink. They become these little squares, barely moving up or down.
They look compressed.
Exactly. In technical analysis, we call this consolidation. But psychologically, it represents indecision. The market had pushed the price up for 2 months, and suddenly, traders started asking, is this too expensive? Should I take profits, or is there more gas in the tank?
It's like the market is holding its breath.
Perfectly put. And when the market holds its breath, energy builds up. The stock rarely stays flat for long. It's building this potential energy that has to be released, either up or down.
And in this case, the release was definitely down. We move into mid-January, and the chart just falls apart. That gentle slope turns into a vertical drop.
It's a breakdown. You see those long, aggressive red candles. They are 3 or 4 times the size of the December candles. That indicates a massive shift in sentiment. It's not just a few people selling. It's a rush for the exits. The price sliced right through the support levels that had held it up for months.
It looks panic-induced. There's almost no green in that entire January section.
It's just red bar after red bar, digging deeper every single day.
That is the visualization of fear. When you see a drop that steep with very few pauses, it means buyers have completely evaporated. No one wants to catch the falling knife.
But the story doesn't end in the basement. We look at the far right of the chart, early February 2026, where we are now. It looks like the bleeding stopped. We're seeing green again. The line is curling back up.
We're in a recovery phase. The panic subsided, and maybe some value hunters stepped in. They looked at the beaten down price and said, okay, M&M is on sale now.
But, and this is a big but, I want to zoom in on the specific data for today. The chart gives us the raw numbers for the most recent candle on the far right. Let's break this down because I think it tells a micro story that, well, it kind of contradicts the happy recovery narrative.
Okay, go for it. What are the numbers telling you?
Okay, so we have an open of 3704.70 and a high of 3787.00. So at some point today, the stock rallied almost 80 points. That sounds great.
It shows early optimism, for sure. The bulls tried to make a run for it.
But then look at the close, 3674.90. Not only is that way below the high of the day, it's actually lower than the open.
And that is the critical detail. If this were a candlestick, it would be red. You have what we call a long upper wick.
An upper wick. So that's the thin line sticking out of the top of the candle.
Exactly. That line represents the journey the price took. It went all the way up to 57.87, but it couldn't stay there. Sellers stepped in and hammered it back down.
So it's a rejection.
That long wig is a visual representation of rejection, yes. The market said, no, we are not ready to pay $37.87 for this stock yet.
So even though the general trend for February has been recovery, today's specific action suggests the sellers are still lurking in the shadows. They haven't left the building.
Precisely. It signals resistance. The easy part of the recovery, that first bounce from the absolute bottom, is over. Now the stock has to fight for every inch.
This feels like a perfect moment to layer in the other indicators. We've talked about the price action, but let's talk about those arteries, the wavy lines. You call them Bollinger Bands.
Right. This is layer 2 of our analysis, the volatility.
So just looking at them, you have a red line in the middle and two green lines sandwiching the price. What exactly are we looking at here?
It's simpler than it looks. The red line in the middle is just a moving average, usually a 20-day average. It's the norm.
The baseline.
The baseline. And the green lines on the outside represent standard deviation.
Okay, standard deviation. I'm having flashbacks to math class.
Hey, just think of it as the normal operating range. Statistically, something like 95% of the price action should happen inside those green bands. When the bands are wide, it means the stock is volatile, swinging wildly. When they're narrow, it means things are quiet.
I noticed that back in December, during that stagnation period we talked about, the bands got incredibly tight. They pinched together.
That is a classic signal called the squeeze. Remember we said the market was holding its breath? The Bollinger Bands visualize that compression.
Ah.
When the bands squeeze that tight, it's a warning siren that a big move is coming. The volatility has dropped so low that it has to expand.
And expand it did. When the crash happened in January, look at what happened to the relationship between the candles and the bands. The red bars didn't just touch the bottom green line. They punched right through it.
That is a breakout and a very specific type. When a candle closes below the lower Bollinger Band, it's a statistical anomaly. It's an outlier event.
So it's like the stock broke the rules of its own variance.
Exactly. It tells you that the selling pressure was so intense, it pushed the price into a zone that is mathematically unsustainable in the short term. We call that being oversold.
Oversold, okay.
When you see the price hanging out below the bands like that, you know the rubber band is stretched to its breaking point. It has to snap back.
And that explains the sharp bounce we saw in early February. It wasn't necessarily that the company released good news. It was just physics, the rubber band snapping back.
Often, yes. It's a mean reversion trade. The price had gone too far too fast.
So where are we now relative to the bands?
Well, look at the chart. The price has snapped back. It's no longer outside the green line. It's floating comfortably in the space between the lower green band and the middle red line.
It looks safe.
It's safe, but it's also in no man's land. It hasn't been strong enough to cross back above the red line, the average. It's just drifting. The volatility has stabilized. The bands are starting to run parallel again rather than flaring out.
So the panic is over, but the party hasn't started.
That's a really good way to put it. The bands are telling us that the extreme event has passed, and we are entering a new phase of normalization.
Okay, let's move to layer 3, the truth serum. I'm talking about volume. This is the bar chart at the very bottom of the image.
I love that you call it truth serum, because price can lie, but volume, Volume rarely does.
Explain that to me. Why can price lie?
Well, imagine a stock drops 5% in a day. That looks bad on the price chart, right?
Yeah.
But what if I told you only 100 shares were traded?
It doesn't mean anything.
Right. It means two guys in a basement decided the price was lower. It's not significant. But if the price drops 5% and 10 million shares trade, that is the market screaming a verdict.
Okay, so looking at this M&M chart, the volume tells a fascinating story during that January crash. Throughout November and December, the volume bars looked like trimmed grass, very even, very low. But then, late January, boom, skyscrapers.
We call those volume towers. And look at where they align. They line up perfectly with the steepest part of the price drop.
So on the days the stock was crashing the hardest, the most amount of people were trading.
This is a textbook capitulation event.
Capitulation. That sounds like a surrender.
It is. It's the moment when the pain of holding the stock becomes too much for the average investor. They look at their loss, they panic, and they hit sell market. They don't care what the price is. They just want out.
Wow.
That massive spike in volume is the sound of everyone rushing for the exit at once.
It looks terrifying on the chart.
It looks scary, but for a seasoned analyst, a volume spike like that during a crash is actually a positive sign.
Wait, how is a panic crash positive?
Because it clears the deck. Think about it. If everyone who was nervous has finally sold, who is left?
Only the people who aren't nervous. The strong hands.
Exactly. The weak hands are out. The people holding the stock now are the ones who have conviction. Also, for every seller, there has to be a buyer. If millions of shares were sold in panic, someone was on the other side buying them.
Smart money.
Often, yes. Institutions love capitulation. They sit there with their buckets and catch the falling shares at a discount. That high volume tells us that a huge transfer of ownership happened, from the fearful to the opportunistic.
And if we look at the volume now, today, in mid-February, it's dropped off significantly. The bars are small again. We can see the axis labels 3L, which is 3 lakhs versus the peak of 41L. We are way closer to the 3L mark.
The storm has passed. The shouting match is over. The volume drawing up here confirms what we saw in the Bollinger Bands. The market has found a temporary equilibrium. The panic sellers are gone, but the aggressive buyers haven't really returned yet either.
Which brings us to our final layer. Layer 4. The pulse check. The RSI. That single line oscillating in the middle panel.
The relative strength index. This just measures momentum. It's like the speedometer on your car. It tells you how fast the price is moving and in what direction. The scale goes from 0 to 100.
And looking at the chart, the current value is explicitly marked, 49.00.
49.00. I mean, you practically never see a number that perfect.
It's basically 50. It's the exact midpoint.
But look at where it came from. Look at the shape of the RSI line back in January.
It's a sharp B shape. It dove deep. It looks like it went well below the 30 mark, maybe down to 24 or 25.
When RSI drops below 30, that confirms the oversold condition we talked about with the bands. The momentum was completely broken. But look at the angle of the recovery. It shot straight back up.
It didn't meander. It spiked back up. But it stopped right here at 49. Why stop there?
Because 50 is the battleground. In RSI terms, anything above 50 is generally considered bullish territory, and anything below 50 is bearish. Hovering right at 49 means the stock is literally sitting on the fence.
It's checking its GPS, recalculating.
It really is. After a heart attack, which is what that crash was, the patient doesn't immediately go run a marathon. The heart rate stabilizes. That's what RSI 49 represents. Stability.
It's funny because as a beginner, I look at 49 and think boring. I want to see it at 80 or 20. I want action.
And that's how beginners lose money. They chase the extremes. But the professional looks at 49 and says, okay, the volatility has reset. Now I can watch for the next real move.
So let's bring this all together. We've dissected the patient. We've got the price showing a failed rally today with that upper wick.
Yep.
We've got Bollinger Bands showing we are back in the safe zone, but still below the average. We've got volume showing the panic is over. And we've got RSI sitting dead neutral at 49.
If this chart could talk, it would be saying, wait.
Wait.
Yes, this is a classic wait-and-see setup. The market is trying to decide on a narrative. Narrative A is, the January crash was a mistake, an overreaction, and we are going back to the highs.
And narrative B.
Narrative B is, the January crash was a warning, the recovery was just a dead cat bounce, and we're about to go lower.
And the chart isn't tipping its hand yet.
Not yet. The wick on today's candle, that rejection at 3787, tilts the scale slightly towards the bears. It shows that there is still supply overhead. People are still looking to sell into strength.
But the volume is low.
But the volume drying up suggests the intense selling pressure is gone. It's a contradiction.
So if you were holding this stock or looking to buy it, what is the signal you were waiting for?
I'd be watching that middle red line, the moving average and the Bollinger Bands, and I'd be watching the RSI level of 50. If the price can cross above that red line and the RSI can push past, say, 55 or 60, that confirms the recovery is real.
And if it breaks back down?
If it drops below the low of that panic day, then look out below. But right now, we are standing in the center of the seesaw.
That's a powerful lesson, honestly. We always want the deep dive to give us a definitive answer. Buy M&M or short M&M. But sometimes the deepest insight is realizing that the data itself is neutral.
That is the mark of a mature investor, knowing when not to do anything. Most people feel the need to be in a trade all the time. But cash is a position too. Waiting is a position.
The chart captures the psychology of the crowd so perfectly. November was greed, December was doubt, January was terror, and February is an anticipation.
And we are right in the middle of that anticipation phase.
It really highlights how emotional this game is. We look at these cold, hard numbers, 3704, 3674, but they are just the aggregate score of human emotions.
That's why I liked your cardiac monitor analogy at the start. It's measuring the vital signs of a living organism. The market is alive. It breathes, it panics, it rests.
So here is a final thought for our listeners to mull over as they go about their day. We live in a world that is obsessed with extremes. We love the all-time highs and the market crashes. That's what makes the headlines. That's what gets the clicks.
Extreme sell, no question.
Exactly. But this chart ends at RSI 49.000, the perfect middle. It's essentially a coin flip. And in a data-driven world, we hate coin flips. We crave certainty. We want the algorithm to just tell us the answer.
But the algorithm is just a mirror of our own uncertainty.
Right. So the question is, how do you make decisions in investing, in your career, in your life, when the data tells you that you are standing precisely in the center of uncertainty? When the signals are mixed and the momentum is zero?
That is the million-dollar question. Sometimes the hardest thing to do is to just sit on your hands and watch the story unfold a little longer.
Patience is the ultimate edge. Thanks for joining us on this deep dive into the lines, the wicks, and the towers. Hopefully the next time you see a stock chart, it looks a little less like The Matrix and a little more like a gripping novel.
Keep looking for the signals.
See you next time.